Hi, and welcome to Janken's Guide on Risk, the YouTube channel dedicated to the theory and practice of risk management. In this video, we're going to rethink corporate foreign exchange risk management and challenge some of its legacy practices. And you'll find the full story in my book, Corporate Foreign Exchange Risk Management, co-authored with Alfred Wienesen and Lars Uxelheim. There's more information on my webpage, riskbudgeting.se, and as they say here on YouTube, please like and subscribe. So what is foreign exchange risk management? Well, if you take a simple definition of risk management as managing variability in corporate performance, it follows that foreign exchange risk management is about managing the impact of exchange rate on corporate performance. There's a need to translate and convert assets and liabilities and cash flows in foreign currency into home currency. And because if exchange rates move around a lot, so will the reported financial statements and therefore corporate performance. So we'll use that simple definition for now. No need to complicate things at this point. What seems to come to many people's mind when they hear the term foreign exchange risk management is derivatives. So that there's a strong focus on hedging exposures using financial derivatives to the point where they almost seem to become synonymous. And there are two legacy practices related to that. The first is that there's a lot of hedging of short-term transactions going on. So people worry about the impact of exchange rate on the margin, the operating margin of a certain receivable or payable, and they want to protect against that. And it's also kind of gratifying to hedge with the kind of exactness you get from these receivables and payables. I mean, they're very well defined, so you can tailor an exact hedge of that. So it's pleasing from that point of view. We also know from academic research who've looked into this that there's a significant opportunism among corporates when it comes to market risks, and they use financial derivatives accordingly as a way to generate excess profits. And well, we take issue with both these practices. I mean, there's very little risk reduction to be had from hedging these short-term transactions. All you really achieve is the short-term forward rate rather than spot rate, and they tend to be equally volatile. And there's no evidence to suggest that firms are successful at selective hedging. So it doesn't on average generate any excess profits, and but it does lead to reduced transparency as firm outsiders find it harder to understand what's going on, and there's no consistency in the use of hedging, and you don't know really what you're going to get or what this company is up to. So transparency goes down from selective hedging. All right, so our view of foreign exchange risk management then is that it encompasses a much broader range of activities, right? And I'll go through them here. The first is the organization of the foreign exchange function. So you need a well thought out organization of how you're actually, or who's allowed to do a foreign exchange risk management. Are you going to allow business units to do this under some circumstances, or is it going to be entirely centralized? These are important issues that must be addressed before starting with any actual hedging and such. So also exposure measurement is obviously going to be part of foreign exchange risk management. You're going to have to establish a set of measures that indicate the level of exposure to exchange rates. Foreign exchange risk management also encompasses choosing a currency composition for your assets and liabilities in a sensible way that sort of balances out your commercial exposures. It also includes operational hedging, which is meant the use of production strategies and pricing strategies in such a way that your exposure to foreign exchange risk is altered. And obviously, foreign exchange derivatives could very well be an important part of this, but it's not exclusively about that. All right. So also formulating a well thought out policy is important. You have to have some kind of guidance in terms of when a hedge should be executed, and you know what's going to be the logic that drives foreign exchange risk management activities in this firm. And we have to decide on whether to use hedge accounting or not. That can have some important consequences for how the financials behave and the numbers we present. So, but it comes with a number of pros and cons that have to be evaluated, right? So that's also part of foreign exchange risk management. As is risk communication, then, which is about how you explain to the outside world what your hedging positions are and the sort of the policy that underpins this activity, right? And this is also important because these are the people who are going to value your firm and decide whether or not they are going to extend you the benefit of doubt. So, and that credibility you can build up using the right kind of communication. All right, so that's a much broader take on what corporate foreign exchange risk management is, rather than a narrow focus on derivatives, right? So what we think is that, first of all, you have to get good at understanding your exposures. I mean, this is crucial to a well-executed foreign exchange risk management program. It really begins there, that unless you're well prepared by being able to anticipate the consequences of different exchange rate scenarios, it's going to be very hard to have a meaningful risk management strategy. So it takes a very keen understanding of your exposure. And we also feel strongly that the setting in which risk management strategies should be developed is the corporate value creation process, the strategic goals that we're striving towards. And that's what foreign exchange risk management should support. It's not about the next couple of months receivables or payables. It's whether or not the company can execute its reach its strategic goals and create value in that process. So if your foreign exchange strategies can support that, then you can most likely claim that the whole thing is for the better and it's value creating. All right. We also think that there's not a singular objective to foreign exchange risk management. What companies care about a lot of things, and what they care about most can vary over time. So many of these things are going to be relevant. I mean, sometimes you hear an endless discussion about whether we should hedge cash flow or hedge net income or something else. We should be open to the possibility that a lot of these things are actually important. I mean, it's multifaceted corporate performance. So we need to be open to this possibility and evaluate on an ongoing basis what is the most pressing need. What in the current situation, what makes most sense to manage. And you have things like cash flow, net income, balance sheet magnitudes, financial ratios. You can use foreign exchange risk management to support all these kinds of performance levels, right? And we'll have to, it's on a case by case basis what is most important. The firm circumstances vary over time, and so should the logic guiding foreign exchange risk management. And we should absolutely, internalize the idea that these are very much interrelated, right? So that if we target one level of performance, that hedging strategy most likely has implications for the others, such as when you have to fair value account your derivatives, even though you're hedging a cash flow transaction, that you will get volatility in net income in the meantime, between now and the cash settlement of the hedge. So there are many of those trade-offs involved here, and it comes back to being very good at understanding your exposures and how these things hang together, and develop your risk management strategies in full awareness of all the potential side effects and consequences of any strategy. So the goal is no surprises. That's when you know that you have done a good job as a risk manager. You are rarely, if ever, surprised by any foreign exchange effect that you have to report in financial statements. It was completely according to your expectations. It may not necessarily be one that you hope for, but if a an exposure is understood and accepted, and something later happens, that's a loss you saw coming was perfectly anticipated, given the knowledge you had. So, first of all, no surprises, right? All right, so foreign exchange risk management reduces variability in corporate performance. In this strategic setting, then you can use it to various ends here, like protect your cash flow when that makes sense, or protect operating margins if that is high on the agenda for some reason, or you can use it to protect financial ratios then that are important as part of running the company. You have these financial ratios, right, that you're keeping track of over time, and there may be certain threshold levels that you don't want to fall below. Those things can be achieved with sensible, well-devised foreign exchange risk management strategy. So if done right, then you support these strategic objectives, and the value creating process in the firm can sort of continue undisturbed, and that's a goal worthy to strive for when it comes to foreign exchange risk management. That this is the setting in which it takes place. So you're thereby helping support the business plan, the execution of that you actually have the cash flows available when you need to invest and that sort of thing. Your cash flow commitments are never under threat, and you're always able to service that with enough liquidity. You're safeguarding your loan covenants so that you don't get into trouble with the banks. So these are all strategic objectives that foreign exchange risk management can and should support. And we're also able to highlight some best practices here. We do believe that centralizing exposure management to a very large extent is the way to go. That brings a number of benefits, ranging from getting better rates from banks, and you are able to coordinate foreign exchange risk management in a different way. You have more control of what's going on. Nobody's executing a speculative hedge in some part of the organization that catches you by complete surprise later, that sort of thing. And so there are plenty of good reasons to centralize exposure management and allow business units to focus on what they do best, which is running their business, right? There shouldn't be dealing with financial derivatives when you have that at the corporate level. So pool your expertise at the corporate level and have the business units run their business. All right. So also netting exposures is a crucial goal here in foreign exchange risk management, that we want to avoid the hedging of gross exposures, get them down to some kind of net exposure that incorporates all the effects of various business activities in the firm, so that any costs in a particular currency are netted out against revenue in that currency, so that we go for the net number, thereby avoiding a lot of inefficiencies that come from targeting numerous smaller transactions. We also should be well attuned to the concept of correlations here, that many of these currencies are correlated with each other and other market rates or prices that we have an exposure to. So once we're informed about the extent to which they tend to co-vary, we can use that knowledge to devise improved strategies. This is the portfolio view on risk management, right? And foreign exchange risk management should definitely take advantage of this kind of knowledge, and look at this as exposure to a portfolio of exchange rates together with other exposures. So that's a fully integrated kind of risk management we're talking about here. And there should be a firm-wide corporate policy, when it comes to foreign exchange risk management, that unifies how we go about doing things in all these respects, so that there's only one single corporate philosophy for foreign exchange risk management, so that everything aligns with that and supports that. You don't have goes back to the centralization issue, that it's only the corporate view that should hold sway at the end of the day, and not so many independent, foreign exchange risk management activities run in the corporate group. So these are some good, some best practices that we can strive towards, and once we get there, we can start to claim that foreign exchange risk management is truly value creating. Also, it should be a point on the agenda of executives and directors, right? So it's very much a strategic activity and should not be left to treasury or any other single corporate function. I mean, usually treasury is very integrated in their thinking, and they worry about things like liquidity and financial ratios that are obviously in the best interest of the firm. But there are cases where treasury operates according to a very narrow worldview, and they're pursuing goals that are not evidently, connected to the achievement of strategic objectives and the value creation process in the firm. So it's possible for treasury to become like a silo with a fragmented approach to FX. There's plenty of examples of that around, and that we have to watch out for. It's not we want to avoid that kind of fragmented approach where they're pursuing many numerous minor objectives rather than this integrated view where the goal is to support corporate strategies. So one way to get there and ensure this is to shift the responsibility for devising foreign exchange risk management policy to a risk committee, which is dedicated to that task. You can set it up essentially for that purpose, right? And whoever is in this committee is informed that they're there to develop risk-enhancing risk management strategies for the group as a whole, in the context of these strategic objectives then. And all the firm's risk management policies essentially are devised in that context, so that they take each other into account, and they all come from this unified philosophy with respect to risk management. And that's also the appropriate context for foreign exchange risk management to be considered. All right, so in conclusions then, we are trying to say here that we do well to move away from the traditional focus on short-term transactions and opportunistic use of derivatives. That's the legacy of foreign exchange risk management. We're going to get supremely good at understanding our exposures. This is where we need to start and put in some work, do the homework, and we're just going to take on assume the attitude that the surprises are unacceptable. We have to understand what's going on multiple levels of performance, right? And foreign exchange risk management policies should be crafted then in a setting where we're trying to achieve the corporate goals, like implementing the business plan and safeguarding important cash commitments and that sort of thing, so that the value creation process is intact and not disturbed here. So, all right, so that's a rethink of corporate foreign exchange risk management, and we conclude for today. All right, so please find more in my books, Corporate Foreign Exchange Risk Management and Empowered Enterprise Risk Management. There's more on riskbudgeting.se, and please like and subscribe. Have a good day.